Once upon a time, the monthly employment report out of the US really mattered. It was a report that was always sure to inspire volatility and a report that was deemed to carry many insights into the future decision-making and direction at the Federal Reserve. But for many months now, this report has lost a whole lot of its appeal and doesn't pack the same market-moving influence as it once did. We'd like to propose two important reasons why this is so. The first is because the NFP prints and unemployment rate have been sitting at very healthy levels for a period of time that would have already easily justified much higher interest rates had we not been living in such exceptional post-2008 crisis times. And so even if there is a one-off disappointment here, it shouldn't do anything to rock the boat. And if the data exceeds expectation, there's nothing more to be gained as far as green lights from these components to be normalizing policy. We've already got them. The second reason this report has taken on less meaning is because economic data on the whole is meaning a lot less these days as market speculation tools. There were already signs of this in 2017, but in 2018, it's becoming abundantly clear that everything centers around the political. The moves at the White House are at the top of this list, but there's been action on the political front that has been shaping the landscape all around the globe. Brexit is, of course, another example. The point here is the market just isn't going to be as interested in the U.S. jobs report at the moment because the forces of global trade wars are something at play. If anything, we would argue the Fed is actually secretly, maybe even rooting for a softer set of data today. There is one component we have spent a lot of time talking about, which is the only component that could make a difference, and this component is average hourly earnings. This has been an area where the efforts of monetary policy accommodation have not been realized as of yet. Though we have seen accommodation result in an unemployment rate that is looking to match its lowest level since 1969, hourly earnings have yet to show any signs of really picking up. This has been a concern over at the Fed, but not a concern it's likely to have at the moment. That's because if hourly earnings race higher today, it will put a lot of pressure on the Fed to need to be hiking rates a fourth time this year and even more further out. But given the fragility in the global economy at the moment and the Fed expressed concerns about downside risks associated with U.S. trade policy, it won't be wanting to have any additional pressure to need to be hiking rates on account of a sudden shooting up of hourly earnings that triggers the return of inflation. But overall, this report shouldn't mean as much to the market, with only that hourly earnings component to factor if it deviates significantly one way or the other. As far as the actual data goes, the market is looking for an NFP print of 190K up from 157K previous, the unemployment rate to dip down to 3.8% from 3.9% previous, and average hourly earnings are expected to hold steady at 2.7% year on year. That's all for now.